let us begin. Melinda, thank you so much for being on the podcast. Appreciate you being here.
Thank you for having me.
Absolutely. So you cover bank tech at American Banker, probably the most trusted publication in the US. How did you find your way to American Banker?
I had my 1-year work anniversary just a couple of weeks ago. So I've been at American Banker for about 1 year exactly.
Okay.
And I landed at American Banker right after college due to an internship program through the Dow Jones News Fund that I was a part of my junior year of undergrad. So I went straight to
Awesome.
American Banker out of school, no steps in between. And it was through an opportunity given to me by the Dow Jones News Fund internship program that I got connected with the parent company that American Banker owns a couple of years before I came here full time.
Amazing. So how did this internship pop up on your radar?
My journalism professor recommended that I apply. I was in a business reporting class. He was one of the directors for the business reporting track of the Dow Jones News Fund in New York City, which is where I was going to school. He recommended I apply. I went through the testing program as well as the essays, applications, interview process, and such, and was one of a cohort of 6 that all came to the same parent company that owns American Banker, and we all got assigned to different publications. I originally wrote for digital insurance in that internship, so it wasn't American Banker at first. That was the publication I came to once I graduated because they were the ones hiring at the time.
Got it. Okay, cool. Well, that is a right place, right time, and
Indeed.
type of story, and working hard, tale as old as time.
No, definitely a blessing of meeting the right people at the right time. And one of the biggest things I got out of going to college was that networking, was meeting those people, was being in the right place, was getting to be accepted into those programs and receive those opportunities I wouldn't have gained otherwise.
Absolutely. Okay. Well, appreciate the background. So you recently published a really interesting article. If somebody hasn't read it yet, we will include a link in the show notes here. But you recently met with one of the head honchos at Experian, Scott Brown, who essentially heads up the financial services and marketing division of Experian, to talk about what could be a breakthrough product called Experian's Credit Plus Cash Flow Score. At a high level, what would you say differentiates this model from the incumbent models that have been out there? The credit decisioning is not a new thing.
Mm-hmm. The differentiator is that every type of method used to determine a potential borrower's creditworthiness is combined into a single score. Cash flow scores have been around for a while. Traditional credit scores have been around for a while. This particular score takes all of that and puts it together into a single score instead of an aggregate of multiple scores and multiple algorithms that a lender would need to do manually.
Okay, got it. And I am seeing here in the article that there is a claim that this may actually improve predictive accuracy by 40%. I know a lot of what you do is investigative by nature. When you met with Scott, I guess, what other parties did you connect with when you were trying to get to the bottom of the story?
That 40% figure is definitely according to the company's internal analysis.
Okay.
But that internal analysis did see positive results, even with the predictive accuracy open to adjustment as the rubber meets the road and it becomes tested in real time. The other sources I reached out to were mostly consultants in the banking and underwriting sphere. For example, I talked with a bank consulting firm called CCG Catalyst and its founder, Paul Schaus, who has been paying attention to and watching underwriting and cash flows and open banking for a while, and was able to give me some good context around how it compares to incumbent products such as VantageScore.
Okay. So you were able to meet with somebody who spent time in the trenches, and he provided you with some insight. What was his hot take on what they're trying to do here?
Paul Schaus, when he was explaining the role that this new score has, compared it to both Vantage Score and the Ultra FICO score, which debuted
Okay.
back in 2018. And those all use cash flow data in some way, shape, or form, whether it's exclusively cash flow or whether it's cash flow data supplementing. The main difference being that it's historical cash flow data instead of real time, which is what Experian is hoping to capture.
Got it. Okay. And this is live. This is still in beta, or is this generally available today?
My understanding is the new score is live, but how lenders use it very much depends on the individual lender, the individual client. It's an opt-in type of system. It can be available, but that doesn't mean that it's widespread. When I was talking with Paul Schaus, he anticipated that it wouldn't become widespread for at least another few years,
Okay.
just because of how well established traditional FICO-based credit scores are. And as regulatory environments shift to favor alternative data, we could see that come in a little more quickly, but in the banking industry, nothing is ever truly fast.
Nothing is fast, unless it's tied to lobbying.
That is true.
Recently Trump was talking about a 10% cap on, I want to say, penalty pricing on credit cards. And
Yes.
the
Every bank is panicking because
they've
they're being
got,
asked to
yeah,
do in weeks what normally takes months or years. So we'll
exactly.
see how that all settles out. But yes, those kind of accelerated timelines are not a thing when it comes to banking and finance because they're so risk averse and want to make sure that absolutely nothing can go wrong.
Yeah, no, for sure. And especially when we're talking about the guts of the business, the lending operation, and the way that risk is evaluated and the way that decisioning takes place within a bank or a credit union, that kind of black box model. They don't like to take it apart and swap things in and out and death by committee and review, the whole thing. So no, I get that. There's a wider trend happening right now, which obviously everybody's talking about: open banking. Do you think that this approach to scoring someone's credit worthiness is going to dovetail with the rise of open banking?
Yes, but it's a little bit of the inverse in that the adoption of open banking will lead to the adoption and regular use of models such as these. The cash flow data only can be given to a credit reporting bureau in real time if a consumer gives permission to do so and if the technological infrastructure exists for that to happen. And that's the core of the open banking conversation.
Hmm.
So as open banking adoption accelerates, that will create the traction needed for cash flow based scores like this one to really become more commonplace. But as you know, the regulation around open banking is very much up in the air right now. So it remains
Right.
to be seen how quickly that will actually happen.
Yeah, no, it'll be interesting to see what happens through like administration changes with open banking, if it's picks up speed, if it slows down. I mean, it kind of seems like it's the cat's out of the bag on it, and there's no real slowing it down, especially as you see it take off in Europe and overseas. So, but again, we do move a little slower here. But it's interesting when you look at the traditional kind of scoring models: credit, alternative data, cash flow. They're asking really different questions, right? You have traditional credit, which is asking the simple question: has this person paid on debt? And then alternative data is, are these guys meeting their day to day obligation, paying utilities, paying rent? And then cash flow is all about, is right now a good time or not for them? And so
Mm-hmm.
I don't see how things don't continue to move in this direction, but ultimately time will tell. And I think the open banking piece will definitely help accelerate things.
Mm-hmm.
So I guess if this does end up picking up speed based off your exposure to the market and the many people that you're talking with, who do you think is going to feel the impact of this the most? Do you think it's going to be banks, credit unions?
I believe that it's consumer lenders that are going to see the impacts first. Those individual loans, those smaller loans, those types of borrowing where a lender is working with an individual that has either a poor credit history or a thin file history, or just doesn't have access to the same kind of data and information that a well-established consumer would have. That's where they would find a use case for cash flow-based underwriting the most quickly. And we've already seen that consumer lending is the main area where these new forms of underwriting are being launched. So that's the main area I see it taking off first. Mortgage lending, definitely not. That's very well established. They have their own systems.
Sure.
FICO is well put in place there. Auto lending is another potential area, but again, like mortgage lending, it's a lot of their own systems there already for determining who
Right.
qualifies for an auto loan.
Sure.
And of course, with credit cards, each individual credit bureau has their own score and their own system, and credit cards have relationships with those credit bureaus already.
Okay. Okay. Interesting. So it's a narrow-ish use case potentially.
Narrow for now, but especially as you mentioned, community banks, credit unions, those that work with a lot of consumer loans and small business loans and individual personal loans would have both the use case and the market share of individuals that haven't been as served as well by larger, more traditional credit options, institutions, or lenders.
I feel like there is a real big play here for institutions to help serve thin file customers and underserved communities and populations. Is that accurate?
Absolutely. Last year, I wrote an article that highlighted how Navy Federal Credit Union partnered with a cash flow underwriting based fintech called Bloom Credit. And those two, in partnership with TransUnion, set up a system whereby young armed forces members who are enrolling in the military right out of high school and become members of Navy Federal are able to boost their credit score with payments such as rent and utilities without necessarily needing a long credit history, particularly as they are applying for housing when they get deployed. So that's an instance of a very specific use case where somebody who is young and looking to serve their country in their prime years of life, but don't necessarily have an established credit score that they would still need in order to apply for housing, for example, can be assisted through bringing cash flow data to credit bureaus to boost credit scores and give them what they need to reach out to landlords when they're looking for apartments, for example.
That's awesome. I love that. I love that use case and, making the benefits of the banking system more accessible.
Absolutely. That is just one example. As I mentioned, there are definitely other use cases. And as underwriters get connected with banks reaching their local communities, immigrants that have come over and don't bring their credit history with them, for example, and are starting from scratch here in the States, that's another area for an underserved community to really benefit from the more immediate information that cash flow data can provide versus loan history, which creates the classic chicken and egg problem of credit.
Absolutely. I appreciate you coming on to talk through the article that you recently published. Do you mind if we shift gears? I'd love to just pick your brain a little bit about what it's like to work at a place like American Banker and to work as a journalist in this industry. So, as a journalist, you obviously have a lot of people reaching out to you, pitching stories to you, a lot of which are not necessarily newsworthy. I guess, what advice would you give to fintechs who are trying to earn attention and not buy it?
The first thing I can think of is particularly with my beat, which is fintech and bank technology for a bank publication, which means our primary subscribers and our primary readership base are those who work in banking and finance, is the bank angle. Having a bank client that I can talk to, having a connection to how this impacts the banking industry, which is not the same as finance. Fintech does not automatically equate banking, and often that connection needs to be made in order for the pitch to be compelling. And I feel like this shouldn't have to be said, but I receive enough pitches in my inbox for this anyway. A product launch is not newsworthy unless it's a really big bank institution, which rarely happens.
Okay. Okay. Got it. So, what feels huge for you and your world at your organization is not going to knock the socks off the readership.
Most of the time, no. As
Sure.
far as what would, regulatory stories are often a big deal when it comes to banks. So, charters, licensing, whether it's international companies moving into the US, whether it's non-bank companies looking to be a bank, if it's a non-bank company buying a bank, M&A, that tends to
Hmm.
be a compelling story for many of our readers. Anything in relation to pain points for banks, direct deposits, for example, being able to have those sticky relationships with consumers, or anything in relation to cybersecurity and fraud. That's a big concern for banks right now, especially as AI fraud is becoming more and more sophisticated and harder to defend
It's
against.
so good. Oh my gosh. It's so good. Yeah.
So, off the top of my head, those are the big ones: is neobanks, charters, regulation, digital assets, especially as that starts intersecting with banking more and more in a very digital asset friendly administration, and cybersecurity and fraud, because that's a big concern for a lot of banks right now.
Sure. Sure. That makes sense. What are you, I guess, from a journalistic perspective, what are you most excited about digging into in 2026?
Ooh, I'm gonna have to think this one for a second.
I mean, you cover, your beat is huge. I mean, you cover a super wide range of stuff. I mean, you're in everything from payments, digital banking, core banking, M&A. I mean, that's a deep field.
Yeah. Thankfully, I'm not the only one. We have a dedicated payments team. We have a dedicated AI reporter slash editor. It's Penny Crosman who does most of our AI coverage. Cybersecurity and fraud is my colleague Carter Poppy. He does an excellent job in covering those topics. But as far as fintech goes, which tends to be my area of coverage, I'm really intrigued about the number of non-US fintechs that are looking to enter an already crowded US market.
Mm.
They
Hmm.
see something here, and I'm really curious as to both how well that's going to pan out. We've seen some successes and some failures in the past few years of European institutions trying to enter the US, but also just how the market is going to shift and change around so many foreign entrants, basically, whether it's Nubank, whether it's Bunk, whether it's just from Europe or from Latin America, even over from Asia, just all of these different, increasingly global fintech bank relationships as charters are getting approved, as companies are going public when they hadn't for a really long time, and just how those market dynamics shift in a way that impacts banks directly.
No, that is a super interesting topic. And as a marketer, I love to see people get really strategic and unorthodox and funky to drive adoption. There was a challenger bank in New York who it was, unfortunately, but they were providing or comping subway tickets to.
Revolut.
Okay,
It
yes.
wasn't based in New York, but it was a UK based challenger bank. Revolut came to New York, and
Hmm.
one of their promotional campaigns was going down into the New York City subway
Yeah.
system and offering the equivalent of free subway rides.
I love to see those localized strategies manifest and get deployed. Yeah, and it's definitely one of those strategies where it doesn't scale super well, right? Like, Revolut comes to the US and they want to secure a beachhead here and kind of land and expand. Like that doesn't work in Oklahoma or in, many other places. So you have to come up with something different. Maybe
Mm-hmm.
it's they're comping axe throwing or, I don't know, whatever it is. But no, but I love that, and I guess we'll have to keep our eyes peeled for some more of those articles from you. Well, Belinda, it's been great to have you on the show.
Absolutely. Thank you so much for having me, and I look forward to staying in touch. This is a topic that really interests me, both fintech in general and cash flow underwriting. It's been very much a area of conversation for several years. It's not anything new, but being able to see how it evolves over the next couple of years, especially as the open banking conversation evolves and the regulatory environment changes, it'll be really fascinating to see what happens.
Absolutely. Absolutely. Thanks again, Melinda.
Of course.
See ya.
See ya.
Hey, thanks for being here. If you or someone else you know would like to explore coming on the show, fill out a contact form at propagatefintech.com and we can explore some content ideas with you. Also, we are an end-to-end marketing and PR firm only supporting the bank industry. So if you would like to explore going deeper with Propagate, again, feel free to reach out to us and we can explore whatever that you are working on. See you on the next one.